Let's jump straight into this explainer. If you've been following along, you know this is part 6 of our 8-part series, mapping out how the options market actually moves the underlying market. Up to now, we've built the foundation, right? We've talked about the Greeks, the volatility surface, the calendar. But today, we are totally bypassing the theory. We're looking at the exact, literal footprints that dealer hedging leaves on price action. We're going to translate all those market mechanics into real, tradable situations that you will absolutely see on the tape. Today, we're covering the first 5.
So here's our roadmap for today. We're covering the pinned range day, the gamma flip break, capitulation at the lows, the vanna rally, and charm week drift. Let's get right into scenario 1, the pinned range day.
This scenario is what happens when the market gets trapped in this sort of compression chamber between 2 major options levels. If you're watching the tape, it looks exactly like this. The index opens, it travels maybe 0.3%, reverses, and travels right back. Every single push just fades, and the VIX just slowly drifts lower. What you're actually looking at mechanically is a market where dealers are long gamma between 2 massive gamma walls. And because they have this positive gamma exposure, every single time the price moves away from the middle, dealers are mechanically forced to sell the rallies and buy the dips just to neutralize their own risk. The machine is literally actively dampening the market. This setup brilliantly illustrates the difference between pros and amateurs. The pro reaction? They just range trade it. You fade the extremes, you buy the low of the zone, you sell the high, use really small targets, and you rack up a high win rate. The trap is strictly for amateur breakout traders. They're out there chasing breakouts mid-zone, literally donating money all day, getting chopped up, completely unaware that a billion-dollar machine is mathematically forced to sell their breakout.
But listen, you have to know when you're wrong. The invalidation for this setup is a daily close beyond one of those gamma walls on rising volume, especially if volatility, like the VIX or the VXN, actually confirms it by moving up. Write this into your trading plan right now. Walls are regime boundaries. A genuine breach means the entire map has changed and you absolutely must respect it.
All right, moving to scenario 2, the gamma flip break. So what exactly happens when we break out of that pinned range and cross the most important line on the map? Well, this is where the market's physics just violently change mid-session. First, price slides through the known gamma flip level. That's the specific price where the dealer book goes from net long gamma to net short gamma. Second, the whole character of the tape instantly changes. Dips just stop bouncing entirely. The tape goes completely one-directional, the VIX rips, and each new low just comes faster and faster. Third, we look at the mechanics. Dealers are now short gamma. Guys, this is a trapdoor. Below the flip, the stabilizer literally becomes an accelerant. Every single tick down forces dealers to aggressively amplify selling just to hedge their books. Notice how your typical retail indicators completely fail here. The mechanics show us that dealer selling is structurally amplifying downward momentum. Yet, the trap is trusting an oversold RSI indicator and triggering that classic dip-buy reflex that works so well in positive gamma. Hear me on this? The mechanical seller on the other side of your trade does not care if the market is oversold. In a negative gamma regime, oversold means absolutely nothing. So the crucial point here is knowing your invalidation. If the price reclaims that flip level and actually holds above it, the physics revert just as fast as they broke down. You have to respect that reclaim just as seriously as the break. Cut the short trade immediately if it crosses back up. Scenario 3, capitulation at the lows. Once that negative gamma cascade finally runs its course, we eventually hit an exhaustion point, usually after a really brutal multi-day decline. On the tape, you are going to see extreme fear. The put-call ratio will explode above 1.5. Option skew gets stretched to the absolute limit. But suddenly, price makes a new low and then closes off it. Mechanically, what's happened is protection buying has fully saturated. Literally, everyone who wants downside insurance already owns it, which means dealers are maximally short puts. And here is the secret engine of the market bottom. The fuel for the inevitable violent rally is actually the bear's own saturated put positions. If the market just stabilizes for a moment, implied volatility falls, puts decay, and those dealers are mechanically forced to buy back their short hedges. Take a look at this execution contrast, because it's huge. The pro reaction is to immediately stop initiating shorts. I mean, you are paying peak insurance prices at this point, but you also don't guess the exact low. You wait for a real structural trigger, like an update that holds, or implied volatility finally breaking lower. The amateur trap, though, incredibly dangerous. It involves trying to catch a falling knife, blindly buying the very first red to green flicker on your screen while that negative gamma cascade is still fully live. You have to let the capitulation structure form first. And here's how you know you're wrong or maybe just way too early. The invalidation is if implied volatility just keeps making new highs right alongside new price lows, and fresh put volume is still heavily exceeding open interest. If IV keeps expanding, fear is simply not saturated yet, and that trapdoor cascade is still fully eating the market alive. Next up, Scenario 4, the vanna rally. This is easily one of the most misunderstood plays in the entire market. I actually call it the "why are we up, nothing happened" phenomenon. Here is the classic post-event market behavior. Step 1. A massively feared event, like an FOMC meeting or a hot CPI print, passes without disaster. It doesn't even have to be good news, just, not apocalyptic. Step 2. Because the event passed, the massively inflated implied volatility crushes instantly. Step 3. Thanks to a Greek called vanna, as volatility drops, the deltas on all those out-of-the-money puts just collapse. Step 4. Dealers who were short those puts no longer need to hold massive short positions in the underlying stock to hedge. So what do? They buy back their short hedges, relentlessly driving the market up for the next 1 to 3 days. This slide presents a paradigm-shifting truth. You will inevitably hear furious retail traders yelling on social media that the rally is fake. But the reality is right here. The news didn't justify this move, the flows did. The market move does not need the narrative's approval. It is purely 100% mechanical unhedging. So how do we actually trade this? Well, the pro reaction is anticipating this upward asymmetry before the event even happens, and allowing 1 to 3 days for the unhedging flow to fully play out. Do not hold puts through the event paying peak insurance prices right before they expire completely worthless. And whatever you do, please avoid the trap. Do not short the mechanical unhedging simply because your personal assessment is that nothing bullish actually happened. Of course, the invalidation here is when the news is actually disastrous. If the event delivers a genuine shock to the system, vanna works in reverse. Implied volatility expands, put deltas grow rapidly, and dealer selling aggressively amplifies the market break. Finally, Scenario 5, Charm Week Drift. Our fifth play explores the final week before monthly options expiration, and this one is driven entirely by the clock. You've definitely seen this tape 100 times. It's a low-volume, relentless upward drift where every single intraday dip magically recovers by the closing bell. The context is usually a prior sell-off that left massive out-of-the-money put open interest sitting right below the current price. The mechanics? Well, this is peak charm season. Charm is just delta decay over time. As the clock ticks down to Friday's expiry, those out-of-the-money puts bleed delta every single day. The engine is exactly like the vanna rally we just talked about, but it's driven by time instead of volatility. Dealers are mechanically forced to buy back short hedges on a strict daily schedule. The contrast in how you handle this completely separates the pros from everyone else. The pro reaction is simple. Do not short the drift. You're fighting a mechanical daily bed. You can lean long on it, but you absolutely must mark your calendar for OPEX Friday, because that is when this specific flow dies. The amateur trap is finally trusting the rally on Thursday, buying the absolute top of the pin, and then blindly extrapolating that bullishness into the following week, totally unaware that the mechanical support is about to completely vanish. And keep your eyes wide open for the invalidation here. Charm support is conditional. It only works while those put strikes actually remain out of the money. If some catalyst forces price to break down through those big put strikes, deltas expand all over again, and the flow instantly flips right back to heavy dealer selling. So we've covered the pinned range, the gamma flip, capitulation, the vanna rally, and the pre-OPEX charm drift. But I have a question for you before we wrap this up. If all this mechanical gravity pulls the market into Friday's options expiration, what exactly happens on the Monday after OPEX, when literally billions of dollars of options simply vanish over the weekend? Think about the implications of that massive unclench. We are going to dissect that violent aftermath, along with 5 more setups in part 2 of this explainer. I'll see you there.